Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today on our third and last segment of today's show. During the first segment, we talked a little bit about thinking ahead, your next portfolio move, and creating a broadly diversified portfolio, not panicking and going to cash. If you missed that, head on over to the website, dlblain.com. There you'll find archived copies of the show. During the second segment, we moved into speaking about inflation and prospects for the future. We're going to wrap up that topic here in the third segment. So just to kind of recap, remember, inflation is a monetary phenomenon. The increase in gas price or food prices, that's just prices going up. When you hear economists talk about inflation, or Ben Bernanke or people like that, they're talking about a wholesale rise in goods and services across an economy. And we know that the things that people use on a daily basis have been going up, and I don't want to minimize that, but a return to the wholesale inflation of the 70s, I just don't think is in the cards. We talked about disposable income growth in the 70s was running at greater than 10%. Today it's negligible, as you all know. We looked at home price growth in the 70s, once again was rising at greater than 10% per year. Currently, home price growth is not that robust, although it is turning around a little bit. Bank credit, another large impetus to have high inflation, was running at greater than 15% a year, pumping vast amounts of money into the economy. Today we see that growth hovering around the 1% rate. And of course the headline CPI number, which includes this basket of goods that the government comes out with, was running at greater than 10%. Today it's 2%. So there's a lot of dispute over the way they compute CPI. You know, is it applicable to the average person, and does it have the right things in the basket? And even those things, I tend to agree with that. But when you look at comparing apples to apples, and in the 70s this number was at 10.5% or so, and today it's at 2%. Even if it's not completely accurate, it was wrong in both periods. So the point is that it's not growing as fast as it used to be. So those are the four big things we look at for inflationary pressures: income, home prices, bank credit, and the headline CPI. And none of them are signaling, as they did in the 70s, that we have massive wholesale inflation ahead of us. So that's not a big concern that I have right now, is massive inflation coming. Once you see the unemployment rate drop, you will see pressure on all those. You'll see pressure on wages to rise. You'll see home prices start to swing around, and you'll see bank credit begin to expand. So it's kind of interesting to look at. Make sure you look at. I'm a big historian when it comes to financial markets, and you look historically at the factors that preceded sort of this high inflation. We just aren't seeing them today. Well, I wanted to finish today's show off. I'd be remiss if I didn't address the fiscal cliff, which is dominating the airways today, and I thought I would put my take on it. There were some interesting statistics come out. The politicians, the Congressional Budget Office, everybody's done a study on what's this fiscal cliff is going to happen, all the investment banks. The data that I'm pulling from comes from the Tax Policy Center, which is a left-leaning institute, I must admit. So we're going to stay away from the political aspects of their report, which I think are, they need to stay out of that and kind of stick with some of the hard financial facts. And some of this data is very similar to what the Heritage Foundation came out with, which is a right-leaning think tank. And so I just thought it would be illustrative to show what some of the potential results may be. So if you haven't been paying attention at all, the fiscal cliff is a series of tax increases that come into play in 2013. And this is fascinating. If you look at the Congressional Budget Office, because all these things are already current law, nobody views them as a tax increase, or I shouldn't say nobody. The politicians and Congress, it's not really a tax increase. And so if they do something to avert the fiscal cliff It's actually in federal government accounting considered a tax cut. Anyway, something to think about. That averting the fiscal cliff, according to government budgeting, is a tax cut. Anyway, okay, so we looked at a couple of different categories. Number one, what we would consider the poor, average income of about $20,000 per year. They're going to see their tax rate go up about 3.7% or $412. A lot of this is due to the expiration of the payroll, the 2% payroll tax cut that is going to be enacted. So it will also affect the middle class. The middle class, for this purpose of this study, was defined at average income of $64,000. Their average tax increase would be about 3.8% or $2,000. They benefited significantly from the tax cuts that are in place. They're referred to as the Bush tax cuts, which I don't understand because President Obama re-signed the law that extended them twice now. So I don't know why they keep calling them the Bush tax cuts. They're much President Obama's and this Congress's tax cut as anyone. Anyway, so for the middle class, that payroll tax cut is going to kick in, as well as the expiration of the 10% tax bracket is going to hurt them as well. We move into what this study called the comfortable average income of $108,000. We see the average tax hike of about $3,500 for these folks, or 4.2 percentage points. They're a big beneficiary of both the payroll tax as well as the marginal tax rates. Now, a big factor for them is the alternative minimum tax. These folks start to get into alternative minimum tax. If they don't fix that, we'd see their tax increases go up even more. As we get into the rich, average income of $506,000, we see an average hike of $14,000 a year, or 5.2%. And then what this study called the masters of the universe, average income of $2.6 million, their average tax hike would be 7.9%, or an average tax hike of $633,000 due to the fiscal cliff. So as you see, the expiration of the fiscal cliff, it is progressive. As the higher income, it affects them more, but at the lower levels, it certainly, on a dollar basis, is a smaller percentage, but will hit those folks very hard. So we think that Congress definitely needs to do something to avoid making this a massive problem. Well, that's all the time we have for today's show. That I hope you enjoyed it and that you'll come back again and join us next week. So for All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.